All right, let's get into this. We're starting this deep dive with a story, and it's a really fascinating one that kind of cuts right to the core of what we're exploring today.
Okay, I'm intrigued. Lay it on me.
So picture this. You're at a, super lavish party, hosted by some billionaire hedge fund manager out on Shelter Island, just dripping with wealth.
Got it. The kind of party most of us only read about.
Exactly. And wandering through the scene are two literary giants, Kurt Vonnegut and Joseph Heller. You know, Heller, the guy who wrote Catch-22.
Wow, okay, Vonnegut and Heller at a billionaire's bash. That's a scene.
Right. So Vonnegut apparently looks around at just the sheer scale of it all, leans over to Heller and says something like, our host, this hedge fund guy, he made more money in one single day than you've probably made from Catch-22 over the entire history.
Oof.
Wow.
That's a brutal comparison. Designed to sting, you'd think.
Totally. You'd expect Heller to feel, I don't know, small, envious, bitter, maybe.
Yeah, something like that. What did he say?
His response was just perfect, simple, elegant. He just looked back at Vonnegut and said, yes, but I have something he will never have.
Okay.
Enough.
Ah, enough. Wow. That hits hard, doesn't it?
It really does. Enough. Such a simple word, but maybe the hardest thing to actually achieve, especially, it seems, for people who have achieved, incredible success by any other measure.
And that's really the crux of it, isn't it? That word enough. It's this critical piece of the success puzzle that we just constantly overlook.
We really do. So that's what this deep dive is all about. Why? Why do people who have objectively won the game, more money than they could ever spend, prestige, power, why do they still feel this pull to risk absolutely everything?
Their reputation, their freedom, the money they already have.
Yeah, all of it. Just for what? A little bit more. It seems irrational.
It does. And that's the paradox we want to unpack. We're going to be looking into this danger zone of not having enough, using some, frankly, extreme and kind of cautionary tales.
Yeah.
People who had it all and still cheated or made unbelievably foolish bets.
Right, because they were chasing this goalpost that just kept moving further away.
Exactly. And the goal here isn't just to tell stories about billionaire scandals. Our mission is to pull out the practical lessons from these failures. There seem to be about 4 key psychological takeaways.
Takeaways that hopefully help all of us, understand that psychology of ambition and satisfaction a bit better. How you can define your own boundaries so you don't fall into that same never enough trap.
It's about setting your own internal bar, right?
Uh-huh.
Not basing your sense of success on some impossible external benchmark.
Precisely. So let's start with maybe one of the most jaw-dropping examples of this. A guy who reached the absolute summit and then threw it all away. Rajat Gupta.
Gupta.
Yeah.
Yeah, his story is essential here. And to really feel the weight of it, you have to understand just how high he climbed.
Absolutely. This wasn't some kid born with a silver spoon. Far from it.
Not at all. He was born in Kolkata, India. Lost both his parents when he was just a teenager. You know the saying about people starting life on third base?
Yeah, born into privilege.
Right. Well, the source material puts it powerfully. Gupta couldn't even see the baseball stadium from where he began. But what he did have was incredible drive. And clearly, immense intelligence.
And that drive took him incredibly far, incredibly fast. I mean, by his mid-40s, he'd reached what most people would consider the absolute pinnacle of the business world.
He became CEO of McKinsey & Company.
McKinsey, the world's most prestigious, most influential management consulting firm. He was literally advising CEOs and governments around the globe.
And he didn't just stop there. When he retired from McKinsey in 2007, he didn't, go play golf. He pivoted into these major global roles.
Yeah, big stuff. The United Nations, the World Economic Forum.
Partnering with Bill Gates on global health projects. He was also on the boards of huge public companies, Procter & Gamble, Goldman Sachs. I mean, the guy was a genuine global player. Hugely respected, hugely influential.
And crucially for this discussion, hugely wealthy. By 2008, the sources say he was worth around $100 million.
Okay, let's pause on that number for a second. $100 million. That puts you in the centimillionaire club. Right. For almost everyone on the planet, that is an absolutely unimaginable amount of money. It guarantees complete financial independence forever.
Just do the math right. Even a super conservative return, say 5% a year on that $100 million.
That's $5 million a year, passive income.
Which breaks down to, what, over $400,000 a month?
Almost $600 an hour.
Yeah.
Every hour. 20-47. Sleeping, eating, breathing, you're making $600. It's generational wealth, secure, done.
So he had it all, the money, the prestige, the influence, the freedom to do meaningful philanthropic work, which he seemed to enjoy. His family was set for generations. Game over, you'd think.
You would think. But here's the twist. The core of his story for us today. $100 million. It wasn't enough for him.
It just wasn't enough. Why? Why on earth not?
Well, it seems his environment, his peer group had shifted. He was suddenly swimming in a different pond, surrounded by people playing in the billions. He wasn't content being a centimillionaire.
He wanted to be a billionaire. He wanted into what they called the billionaire circle.
Exactly. And there's this telling detail from the sources about how those circles were perceived. He's on the board of Goldman Sachs, right? Surrounded by these titans of finance.
Yeah.
Apparently, some of those private equity guys, the real billionaires, they referred to Goldman Sachs itself as just the hundreds of millions circle.
Wow. So even Goldman Sachs felt like the minor leagues to these guys.
Kind of. And you can imagine how that might have landed with Gupta. Here he is, worth $100 million, sitting on the board of this legendary firm, and maybe feeling like he's still not quite in the real inner sanctum.
That relentless comparison again, that need to climb just one more rung, even when you're already near the top of the ladder.
And that desire, that itch to get into the billionaire circle, seems to be what led him to find a, shall we say, side hustle.
A catastrophically illegal one.
Insider trading.
Yeah.
While sitting on the board of Goldman Sachs, it's almost unbelievable.
The specifics of the crime itself are just breathtaking, especially the timing. It shows how little thought he must have given to the potential consequences.
Right, let's set the scene. It's 2008. The financial crisis is raging. Lehman Brothers had just collapsed. Goldman Sachs is teetering. They desperately need capital to survive.
A real make-or-break moment for the firm.
Totally. And they managed to secure a lifeline, a massive $5 billion investment from Warren Buffett. Huge news, market-moving news.
And Gupta, as a board member, gets to hear about this deal before it's public knowledge. He's on the crucial board call where it's discussed and approved.
That information was gold. Knowing Buffett was stepping in would instantly boost confidence and send the stock price soaring.
Okay, so here's where the prosecution's timeline just nails him. It's incredibly precise.
He's on the board call. The call ends. He hangs up.
And then?
16 seconds later. Not minutes. 16 seconds. He picks up the phone and calls Rajat, a billionaire hedge fund manager.
16 seconds. There's basically zero cooling off period. No time to even think, maybe this is a bad idea.
None whatsoever. The call itself wasn't recorded, but the timing, combined with what happened next, tells the story.
What did Rajat do?
Immediately after that call, Rajat started buying Goldman Sachs shares. Loads of them. 175,000 shares. Just boom, boom, boom.
Betting big based on that timing.
Exactly. Then, a few hours later, the Buffett deal is officially announced to the public. Goldman's stock price surges, and Rajat
Makes a killing.
makes a quick, cool $1 million profit just from that single illegal tip. And that was just one instance.
Right. The SEC estimated his tips altogether led to something like $17 million in illegal profits for Rajat's fund.
Which sounds like a lot, but let's put it back in context.
Yeah.
$17 million compared to the $100 million Gupta already had, completely legally.
It's less than a 20% increase on his existing, legitimately earned fortune. He risked absolutely everything. His freedom, his legacy, his reputation built over decades.
Everything. For what essentially amounted to his status play. To solidify his position, maybe, within that billionaire circle he craved.
And the end result?
Both men went to prison. Careers obliterated, reputations destroyed, just gone.
It's such a stark example of that never enough syndrome leading to total self-destruction.
And it's interesting, his defense initially tried to argue he wasn't even doing it for the money directly, but more to, help out his friend Rajat, to curry favor.
Which, even if true, still points to the same underlying problem, right?
Exactly. Whether it was direct cash or the currency of influence and access within that elite circle, the motivation was still more. More status, more connection, more proximity to the very top at the cost of things that should have been non-negotiable.
It really sets the stage for thinking about others who maybe built things differently, but ended up in a similar place psychologically, like Bernie Madoff.
Madoff.
Yeah.
The name itself is synonymous with fraud. The biggest Ponzi scheme in history, right?
Yeah.
Wiped out fortunes, charities, families. Just devastating.
Absolutely notorious. But there's a piece of the Madoff story that often gets completely buried under the sheer scale of the crime.
And it's crucial for understanding this never enough idea.
It is. The overlooked fact is, Bernie Madoff, before the Ponzi scheme imploded, was already an incredibly successful, very wealthy, and entirely legitimate businessman.
People forget this. They just see the monster, the fraudster. But he had this whole other life, this other business that was real and really successful.
So let's unpack that legitimate side for a minute. What was it?
His main legal business was in market making.
Okay, for people who aren't Wall Street insiders, what exactly does a market maker do?
Basically, they're like the grease in the wheels of the stock market. They stand ready to both buy and sell a particular stock at any given time.
Hmm.
So if you want to sell, they'll buy it from you. If you want to buy it, they'll sell it to you.
They provide liquidity, make sure trading can always happen.
Exactly. And they make their money on the spread, that tiny little difference between the highest price someone's willing to pay to buy the stock, the bid, and the lowest price someone's willing to accept to sell it, the ask. They capture that difference.
And Madoff wasn't just a market maker, he was a pioneer, right? He used technology in a way others weren't.
Totally. This was his legitimate claim to fame. Back in the day, like the 80s and early 90s, most trading still happened on the floor of the New York Stock Exchange through human specialists. Madoff saw the potential of electronic trading much earlier than most.
So he built a firm to do that electronically.
Yes, his firm basically bypassed the NYSE floor for a huge chunk of trades. The Wall Street Journal wrote about him in 1992, calling his firm highly profitable and saying it had siphoned off a massive volume of trades through the big board.
He was a disruptor then, using tech to beat the old system.
Absolutely. And the numbers showed just how successful he was at it, legitimately. At one point, his firm was handling something like $740 million in average daily trading volume, all done electronically off the main exchange.
Wow. How much was that compared to the NYSE itself?
Get this. That volume was equal to about 9% of the New York Stock Exchange's entire daily volume. One firm handling almost a tenth of the NYSE's business through its electronic system. That's huge.
So he's making money on the spread for all those trades.
Yes, but he also perfected this other thing, which is controversial now, but was key to his success then. Payment for order flow, or PFOF.
Right, where brokers get paid to route their customers' trades to a specific market maker. How did Madoff use that?
Because his electronic system was so fast and so cheap compared to the old floor brokers, he could actually pay other brokerage firms like Schwab or Fidelity, maybe a penny or two per share, just for sending their customers orders his way.
And he'd still make money.
Yeah, he'd still make a profit on the tiny spread, even after paying the broker. It was incredibly efficient. And this legitimate market-making business, the sources say, was reliably churning out between $25 million and $50 million in profit every single year.
25 to 50 million a year, legitimately, from a business he built that was innovative and respected.
Respected enough that he even served as chairman of the NASDAQ U stock market at one point. He was a pillar of the financial community, by all outward appearances.
Which brings us right back to that same baffling question we asked about Gupta. Why on earth would someone making, let's say, $30 million a year, honestly, running a groundbreaking, successful firm, why would you risk all of that? Your freedom, your name, your family, everything, to run a massive, stressful, illegal Ponzi scheme on the side.
Especially when the legitimate business already provided more wealth than anyone could reasonably need. It wasn't about survival.
Not at all. And the source material makes that distinction clearly. It mentions, the example of a Nigerian scammer who felt bad about hurting people, but said something like, poverty will not make you feel the pain. That's desperation. That's crime born from having nothing.
A completely different category.
Yeah.
But Gupta and Madoff, they had everything. Wealth, status, power, freedom. They chose to commit crimes not because they needed to, but because somehow what they had wasn't.
Wasn't enough. Their internal scoreboard was just broken. Success was only defined by more, regardless of the cost.
It's a compulsion, it seems, driven by something other than rational need.
And it's not just limited to outright criminals either, is it? This willingness to risk what you have and need for something you don't have and don't need, it shows up in the supposedly rational world of legal investing too.
Oh, absolutely. Sometimes with equally catastrophic results, even if prison isn't involved. Which leads us to the story of long-term capital management. LTCM.
LTCM. A legendary blow-up. This is a perfect example because it involves literally some of the smartest people in finance.
Nobel Prize winners. The firm was stacked with PhDs and renowned traders. John Meriwether, who'd been a star at Salomon Brothers, teamed up with Myron Scholes and Robert Merton.
The guys who developed the Black Scholes model for options pricing. The ones who won the Nobel Prize in economics for it.
Those exact guys. These weren't just smart people. They were finance royalty. And they were already incredibly wealthy themselves, personally worth tens, maybe hundreds of millions each.
So definitely not starting from zero. And what was their genius strategy at LTCM?
It was based on something called convergence arbitrage. Basically, they use complex mathematical models to find tiny temporary mispricings between related securities, like, say, two bonds that should theoretically trade very closely together.
And they'd bet that those prices would eventually converge, come back into line.
Exactly. They'd buy the cheaper one, sell the more expensive one, and wait for the gap to close, capturing a small but supposedly very predictable profit. Low risk on each individual trade, in theory.
Supposedly, and in theory, doing a lot of work there. So what went wrong?
The problem wasn't necessarily the core strategy, it was the scale. In their relentless pursuit of more profit, they absolutely did not they used an insane amount of leverage.
Leverage meaning borrowed money, right? Making bigger bets than their own capital would allow.
Way bigger bets. At its peak, LTCM had something like $4.7 billion in actual capital from its investors. But they leveraged that tiny base into positions worth, wait for it, $1.25 trillion.
$1.25 trillion. From under $5 billion. That's what kind of ratio is that?
It's over 100 to 1 leverage. Maybe even closer to 250 to 1 on some calculations of assets versus equity. They were betting hundreds of dollars for every $1 they actually had. They believed their models were so good, so infallible, that the risk was negligible.
But with that much leverage, even a small, unexpected move against them could be devastating, couldn't it?
Could be. It was. In 1998, Russia defaulted on its government debt. It sent shockwaves through global markets, the kind of black swan event their models hadn't properly accounted for.
So the prices didn't converge.
They diverged violently. The small mispricings they were betting on suddenly became huge losses, magnified by that enormous leverage. The fund just hemorrhaged money.
How bad was it?
They lost $4.6 billion in just a few months. Basically wiped out their entire capital base. Everything gone.
And these were the Nobel Prize winners, the finance geniuses, already worth millions.
Gone. Wiped out. But the really scary part of LTCM wasn't just the founders losing their shirts. It was that their failure threatened to take down the entire financial system with them.
Because they were so big and so interconnected with all the major banks.
Exactly. All the big Wall Street banks had lent them money or were counterparties to their trades. If LTCM defaulted, it could have triggered a domino effect, a systemic collapse.
So the government had to step in.
Well, the Federal Reserve, under Alan Greenspan, had to step in and basically strong-arm the major banks into organizing a private bailout. Not to save LTCM itself, but to manage an orderly wind-down of its massive positions to prevent a global meltdown.
Unbelievable. So these brilliant, already super rich guys, chasing even more money they didn't need, managed to not only lose everything, but also nearly crash the world economy.
During one of the biggest bull markets in history, 1998 was overall a great year for stocks. But their leverage and their flawed models blew them up anyway.
It perfectly illustrates that Buffett quote, doesn't it?
It's the absolute perfect illustration. Warren Buffett's take on this kind of behavior just cuts through all the complexity. Can you share that quote again? It's so critical.
Yeah, it's worth repeating. To make money they didn't have and didn't need, they risk what they did have and did need. And that's foolish. It is just plain foolish.
It's so simple, isn't it? If you risk something important, your reputation, your freedom, your existing capital, your peace of mind for something unimportant, like just more money when you already have enough, it's irrational.
There's no logical upside that justifies the potential downside. You're risking the things you absolutely need for things you absolutely don't need.
And while, okay, most of us listening probably aren't dealing with $100 million fortunes or Nobel Prizes.
Probably safe to say.
Right. But the source material makes a really good point. A decent number of people listening will reach a point in their lives where they earn enough or save enough to cover everything they reasonably need and maybe even a lot of what they want.
Financial independence or something close to it.
Exactly.
Yeah.
And when you get to that point, or even just approach it, understanding the psychology that tripped up Gupta, Madoff, and the LTCM geniuses becomes incredibly important. It's about avoiding their mistakes on your own scale.
It's about not letting that never enough feeling take over, no matter what level you're at.
Precisely. It's about defining your own boundaries before you get tempted to cross them, which leads us nicely into the practical lessons we can take away from all this.
Okay, let's shift gears then. We've seen the failures, the extreme examples. Now, what can we actually learn? What's the practical psychology here? You mentioned 4 key lessons.
Right. 4 takeaways that focus on managing ambition and finding satisfaction. And the first one is probably the most fundamental, maybe the hardest.
Okay, what is it?
Lesson 1. The hardest financial skill is getting the goalpost to stop moving.
Getting the goalpost to stop moving.
Yeah.
Because it always feels like it should move, doesn't it? You achieve something, you aim higher. Isn't that just ambition?
It is ambition, but unchecked, it becomes a trap. It's what some people call the hedonic treadmill. If every time you achieve something, your expectations immediately jump up to match or exceed that new level.
You never actually feel any more satisfied than when you started.
Exactly. The feeling stays the same. You make $50K, you want 80 dayas. You make 80K, you want 120K. You make $1 million, you want $5 million. The effort keeps increasing. The stress might increase, but the feeling of satisfaction doesn't improve because the target just keeps receding.
And the sources suggest it actually gets worse sometimes, that success can make the goalpost move faster.
Yeah, that's the really tricky part. Getting a taste of more money, more status, more power can actually accelerate your ambition faster than it boosts your satisfaction.
So you take one step forward in reality, but in your head, the goalpost leaps 2 steps ahead.
Precisely. Which leaves you feeling like you're constantly falling behind, even as you're objectively becoming more successful. It creates this weird anxiety, this pressure to keep up with a target that you yourself keep moving.
And that pressure, that feeling of falling behind, is what fuels the risky behavior we saw.
It has to be a major factor. If you feel like you're losing ground relative to where you think you should be, even if should is based on a constantly inflating expectation, you start feeling justified in taking bigger risks to catch up.
Like Gupta feeling he was behind the billionaire circle despite having $100 million.
Exactly. And this isn't just an individual psychological quirk. It's kind of baked into our modern system. The source material has this great line.
Which one?
It says, modern capitalism is brilliant at two things: generating wealth and generating envy.
Huh. Yeah, it sounds about right. They feed off each other.
They do. That desire to cape up, to surpass others, it drives innovation and hard work, no doubt. But it also guarantees misery if you don't consciously decide where your own finish line is.
Happiness equals results minus expectations, right?
That's the simple formula. And if your expectations are always running ahead of your results because the goalpost keeps moving, your happiness score is always going to be 0 or negative, no matter how amazing the results actually are.
Okay, so if the moving goalpost is the problem, what's causing it to move? That leads right into the second lesson, doesn't it?
It does. Lesson 2. Social comparison is the problem here.
Yeah.
It's the engine driving that goalpost. And it's a game you just cannot win.
Why is it unwinnable? Because there's always someone richer.
Always. The ceiling is effectively infinite, and our brains seem wired to constantly look upwards, not downwards or sideways. The sources use this amazing comparison chain to illustrate just how impossible it is.
Okay, walk us through that chain.
All right, start with, say, a rookie baseball player. Makes the major leagues, gets the minimum salary, maybe $500,000 a year back when the source was written.
$500,000 a year. By any normal standard, that person is rich, set for life if they're smart.
Absolutely. Rich,
Yeah.
successful, achieved a dream. But who does he share a clubhouse with?
The superstars.
Exactly. He plays alongside Mike Trout, who signed that massive $430 million contract. Trout's making something like $36 million a year.
Okay, so the $500K rookie looks at the $36 million teammate and suddenly feels...
Broke, relatively speaking, of course. But the comparison point immediately makes his own fantastic salary feel inadequate. He's looking up.
But surely Mike Trout feels rich, right? $36 million a year.
Objectively, yes.
Yeah.
But who does he compare himself to? Maybe not other athletes, but the titans of finance. The source points to the hedge fund world. In 2018, just to crack the top 10 highest-paid hedge fund managers,
How much did you need to make?
you need to pull in at least $340 million in that 1 year.
$340 million in a year. Okay, so Trout's $36 million suddenly looks smaller.
Right. And that manager making $340 million, he's looking at the guys in the top 5 who made at least $770 million that year.
This is getting ridiculous.
It keeps going. Those guys might look up at someone like Warren Buffett, whose personal fortune went up by $3.5 billion in 2018.
$3.5 billion increase.
And even Buffett isn't the absolute peak of the single-year increase chart for that period. There was Jeff Bezos. His net worth reportedly jumped by $24 billion in 2018.
$24 billion in 1 year.
Now, here's the mind-bending part that breaks the comparison chain entirely. That $24 billion increase for Bezos, it works out to more money per hour.
Than the rookie baseball player.
The rookie baseball player making $500,000 made in the entire year.
Wow. Okay. Point taken. The ceiling isn't just high, it's in outer space.
Exactly. It's so high that effectively no one, not even the incredibly rich, can ever truly win the comparison game if winning means being at the absolute top. Someone always has more.
So if you're constantly looking up, you're basically doomed to feel inadequate no matter how much you have, like Gupta did.
Pretty much, which is why the only winning move is not to play, or rather to define winning differently.
Define it internally, based on your own needs and wants, not on keeping up with the Bezoses.
Precisely. There's that great analogy in the source material about the casino dealer.
Oh, yeah. What was that?
A friend asked a Las Vegas dealer, what games he plays, which casinos he likes, looking for an inside tip. And the dealer just said, completely deadpan, the only way to win in a Las Vegas casino is to exit as soon as you enter.
Huh. Because the house always wins eventually if you keep playing.
Exactly. The odds in time are stacked against you. And it's the perfect analogy for the wealth comparison game. If you stay at the table trying to keep up, the moving goalpost and the infinite ceiling will always beat you psychologically.
So the only way to win is to decide you have enough, cash out your chips, and walk away from the comparison game.
That's the idea. Define your enough, achieve it, and then consciously stop playing the more game.
Which sounds simple, but it bumps up against this feeling many ambitious people have, doesn't it? This leads to the third lesson, I think.
Right. Lesson 3. Enough is not too little.
Yeah, there's this perception, isn't there, that saying I have enough is like being unambitious, settling, leaving money on the table.
Exactly. People see it as overly conservative, maybe even weak. They worry they'll miss out on some huge opportunity if they set a limit. But that view completely misunderstands the real risk.
What's the better way to frame enough, then?
Think of it not as settling, but as self-preservation. Realizing that the opposite, that insatiable hunger for more, the inability to say enough, is what inevitably pushes you to a point of deep regret.
Pushes you to take those foolish risks Buffett talked about.
Precisely. The source uses another great analogy here, a bit visceral this time.
Okay.
The vomiting analogy.
Oh, dear. All right, let's hear it.
The only way to know the absolute maximum amount of food your stomach can possibly hold is to keep eating past fullness, past discomfort, until you literally make yourself sick, until you vomit.
Right. Not generally recommended.
We instinctively avoid doing that in real life, right? Because the pain and unpleasantness of being sick far outweighs any tiny pleasure we might have gotten from that last unnecessary bite of food. The downside is way worse than the marginal upside.
Makes sense. So how does that apply here?
Well, for some reason, that basic risk management calculation often fails when it comes to careers and money. People do keep reaching for more, even when they're full, even when it's uncomfortable.
They keep stuffing themselves financially or ambition-wise.
Until they break, until they get sick. That sickness might be career burnout, or making a disastrously risky investment decision because they got greedy, or, in the extreme cases like Gupta and Madoff, resorting to crime.
They only find their limit by exceeding it and suffering the consequences.
Which is a terrible way to learn. That inability to just say no to one more potential dollar, one more rung on the ladder, eventually catches up to you. The potential gain seems appealing, but it blinds you to the catastrophic potential loss. Defining enough is about recognizing that risk before you puke, metaphorically speaking.
Okay, so recognizing enough is about protecting yourself from ruinous downside, not about being unambitious. That makes sense. It protects the things that really matter.
Which brings us perfectly to the final lesson, lesson 4. There are many things never worth risking, no matter the potential gain.
The truly invaluable stuff.
Exactly, the non-negotiables. And ironically, the person who perhaps illustrates this best is Rajat Gupta again, but through his post-prison reflections, which, well, they seem to miss the mark entirely.
What did he say? The source mentions an interview he gave.
Yeah, he told the New York Times something like his big takeaway was, don't get too attached to anything, your reputation, your accomplishments, or any of it. Okay, this thing unjustly destroyed my reputation. That's only troubling if I am so attached to my reputation.
Wow. So his lesson was, reputation doesn't really matter that much anyway.
That seems to be what he's claiming. And frankly, as the source suggests, that feels like the worst possible lesson to take from his experience.
Why the worst?
Because it sounds less like genuine wisdom and more like sour grapes, like a defense mechanism. He lost his reputation, arguably the most valuable asset he had besides his freedom, and now he's trying to convince himself, and maybe others, that it wasn't that important after all.
Devaluing the thing he can no longer have instead of acknowledging its true worth and the tragedy of its loss.
Precisely. Because there are things that are fundamentally invaluable, things that no amount of money can justify risking. things that fit Buffett's category of what you have and need.
So what's on that list? The truly non-negotiable assets.
Reputation is definitely on it. Gupta's attempt to dismiss it doesn't change its immense value in life and business.
Okay, what else?
Freedom and independence. Ask Gupta or Madoff about the value of freedom after they lost it. No amount of money matters much from a prison cell.
True.
Family and friends. Your relationships. Being loved by the people you want to love you. These are foundational.
Hard to put a price tag on those.
Impossible. And ultimately, happiness. Your own internal sense of well-being and contentment.
So reputation, freedom, family, love, happiness, these are the things you should never gamble with.
Never. No matter how big the potential financial upside seems. And the best way, maybe the only way, to reliably protect these invaluable things
Is knowing when you have enough.
it comes back to that. Knowing when to stop taking the risks that could jeopardize them. Knowing when to get off the hedonic treadmill. Step away from the comparison game and say, this is enough for me to have a life rich in the things that truly matter.
That inability to define enough really is the ultimate risk then.
It seems to be.
Yeah.
Because it leads directly to risking the irreplaceable for the replaceable.
It's quite the paradox when you lay it all out. The people with the most to lose, the Guptas, the Madoffs, the LTCM partners, are often the ones taking the biggest, most unnecessary risks.
Risks they absolutely did not need to take to live incredibly comfortable, fulfilling lives. They already had enough by any rational standard, but they just couldn't see it or accept it.
So the real goal isn't just compounding wealth forever, it's maybe compounding satisfaction by locking in your definition of enough.
That's a great way to put it, compounding satisfaction. Like Joseph Hedel seemed to understand intuitively at that billionaire's party. He knew he had enough.
No. The source material we looked at ends by hinting that the most powerful tool for actually building that sense of enough is quite simple, doesn't involve risk, and is something we'll explore more next time.
Right, there's more to unpack there.
But just based on what we've covered today, the stories, the psychology, the lessons we wanted to leave you, the listener, with a final thought to chew on.
Okay.
If we accept that the core problem is this unwinnable game of social comparison, this constantly moving goalpost, what's the single most practical, totally risk-free action you could take, like right now, today, to start solidifying your own definition of enough? A definition that isn't tied to what your neighbor has, or what Jeff Bezos made last year.
It implies moving the focus inward, doesn't it, away from the external scoreboard.
Exactly. What does that internal scoreboard look like for you? Defining that, maybe writing it down even, seems like the first crucial step. It requires reflection, not risk.
Defining your own win condition based on those invaluable assets we listed. That feels like the foundation for real financial peace, doesn't it?
It really does. Something to think about. Thanks for diving deep with us today.